So let's begin the class. So today we are doing two-stage dividend discount model. Okay. So here what would happen is this would be like the growth would be something in the previous some years, and then it would change in the coming next some years. Okay. So this is two-stage discount model. So what happens? Let's see. Fast growth industries is growing and its dividend is growing at an annual rate of 20%. This growth is expected to continue for 3 years in the future, after which the growth is expected to slow down to a more sustainable growth rate of 7%. So in the beginning years it was growing at the rate of 20%, and in the coming years it's going to grow at the rate of like 7%, and that too after 3 years. Investors require a 14% rate of return. The next annual dividend is expected to be $1. Okay. Now let's understand. They're asking you calculate. So the first step is to calculate the present value of dividends to be received during the first 3 years. So we'll take this dividend. It is $1. It is growing by 20%, so it becomes 1.20. Again, it's growing by 20%, so 1.20 into 1 plus 0.20. So 1.20 into 1.20. I think it's like 1.44. Fine. And then discounted at the rate of 14%, because the required rate of return is 14%. You get the present value. So this is the present value of the future dividends from 1 to 3 years. Okay, we got the present value as on today for all these dividend payments. Now the next thing what they said is it is going to grow by 7%. Fine. So what we will do, we will take the third year's dividend and find out the dividend of the fourth year. Okay, so project the dividend for year 4. So by multiplying the year 3, that is 1.44, third year's dividend, we will take this, because for the next future value you should have the present value today into 1 plus 0.07, 1.07, that is 1.44 into 1.07. So you'll get the dividend as 1.54. Okay. So this is the dividend of fourth year, correct? Yes. Now pretend that you take fourth year as the first year now. Why? Because from fourth year the dividend is going to grow constantly at the rate of 7%. So that's the reason why we found out the fourth year dividend. From fourth year it's going to be constant growth. So fourth year dividend divided by the required rate of return minus the growth rate gives us the stock price. Okay. So please do this. We will move forward. Till here you can find out. Then this is the stock price as on year 3. We want the stock price as on today. Again you take 22 and you discount it for 3 years. You'll get 14.85. Okay, you know the third year discounted factor 0.675. So multiply that with this, you get the present value of that particular stock as on today. So the stock's present value is 14.85 and the dividend is 2.77. So totally the market price of the stock approximately will be 17.62. Okay. So please do this question. Zarina, I'm waiting. You tell me when to scroll down. I'll scroll down. Okay. Zarina, once done, please confirm me.
Yes, sir, just a minute. Done, sir.
Okay, just check.
Yes, about.
Yep. Last part. Once done, I'll move forward. Okay. Hello.
Yes, sir, done.
Yeah. Now, other valuation methods. There are other ways also to find out the market, the price of a stock like PE. You know, price to earning ratio is market price by EPS, and let's see how we can find out, and we'll do a question. Okay, and then we'll move forward. Now, so earnings multiple, this is the approach. So privately held NMP Corporation has earnings per share of $3. So EPS is $3. After reviewing the price earning ratios of public companies in the same industry as NMP, so they are, what they are doing is they are trying to compare the performance of NMP with some already existing public companies which are in the same industry as the NMP is. The analyst determines that they sell for between 10 and 15 times earnings. So like earnings, like price to earning ratio is market price by EPS, price earning. And what they have seen is, after reviewing the PE ratios of public companies in the industry, public companies in the same industry as NMP, the analyst determined they sell for 10 to 15 times. So P ratio is 10 times, it seems, once, and P ratio, one more given, is 15 times. So now we will take the, what we say, the earnings per share here and try to find out the price of a stock. Okay. So what can be the price of a stock? So P by 3 is equal to 10. That is market price. P is market price. P by 3 is equal to 15. So like 30 and 45. Okay. So the appropriate stock price for NMP would be between these two. That's what we found out. Next, the analyst evaluates the amount of business risk NMP has compared with the business risk for public companies in the same industry. So you know, business risk almost all would be same in many cases. The only risk what differs and which is relevant to us to see or matters is the finance risk, because almost all kind of businesses face the same kind of what we say, the business risk. Okay, so the analyst determines that NMP is on high end of risk profile, it seems. Therefore, the price of NMP stock should be in the low end of the range to compensate for increased risk. That's what. See, since the risk is high in NMP stock, the returns what you want should be more. But like when you want more returns, the stock price would definitely be less. Okay. So high risky stocks, like people are reluctant to buy. Like majority of the people are reluctant to buy. They don't want to buy. So to push that stock, the since the risk is very high for people, they kind of reduce the stock value. See, all is demand supply game, correct? Analyst therefore calculates that an appropriate price for NMP would be 32. So they have calculated. We need not worry about this. They themselves did this because we don't have the data regarding what risk they have and how much is that. Okay, the percentage. So they calculated, it seems. Now what we shall do is, at a stock price of 32%, the earnings multiple of the company is how much? So we'll try to find out the earnings multiple or times. So 32 by 3. So this is the price, market price right now. This is the EPS. So your P ratio is 10.7 times, it seems. So the earnings multiple is at the low end of the range of P ratios for public companies. That is, we have calculated 10 and 15. We know that, sorry, given is 10 and 15, which are the public companies P ratios. And the P ratio what we calculated for our company, the NMP, is the 10.7. And this 10.7 falls is very near to 10. So that falls in the low range, correct? So that's what. So it falls on the low range. That means NMP's P ratio is like at the low range, so less risky. Okay, I meant to say the higher the P ratio, the better it is. Actually speaking, that company has a very good growth prospect. But here, like, they did not ask us like what growth prospect or something like that. They're just asking and concerned with the calculation of stock price. And with calculation of stock price, we've calculated the P ratio also, and that happens to be very near to 10, which is in that range. So we found out this one. Okay, so just see this question, then we'll move forward. Once done, you can tell me, Zerna. I'll move forward.
Yes.
Finished? Okay. So will you try this as homework or shall we solve? Hello?
I'll try it, sir.
Okay,
If I
then
have
these
any
two
doubt,
you
I'll
can
let you
try
know.
as homework. No worries, if you're not getting, you can tell me, I'll solve in the class.
Yes.
So we will read these points now and go for the next question. Okay. Important points. So they are saying the market multiple approach to valuing a business. So the market multiple approach to valuing a business for investment purpose uses the market value of the business that are similar to the business being valued. So I think the market value they are considering to value a business. Okay. So the values of other businesses may be determined either by trading price of publicly traded or publicly owned companies of the business is privately held by the purchase price in a sale of similar privately held business that has taken place. So values of other businesses may be determined either by the trading price, like at what price the publicly owned companies are trading. So we can take the share value and we can find out the company's value. For private companies, what we can do, we can see like if the company is sold today in the market, what people are ready to pay. Okay. So the price or value of the comparable business. See, always we will be comparing the if we want to find out the estimate of our company, we'll be taking a public company into consideration, correct? So the price or value of comparable businesses compared to its earnings, cash flow, or other ratios to derive market multiple values for each factor. Okay. So those market multiples are then adjusted for the riskiness of the subject company. So what we will do to find out the value of a business, okay, we will take a public company that is called comparable business. So the price value of a public company or comparable business is compared to its earnings, okay, cash flow, or other ratios to derive market multiple values for each factor. So instead of this, let's understand the how to find out. So need not worry, we will take this example and try to find out the value of a business. Okay. It will be a better exercise to do a question rather than discussing the theory. So Assimilated Stores Inc. is considering acquiring Takeover Target Inc. So this company wants to take over this company. In its analysis of Takeover's target financial statements, Assimilated has developed the following balance sheet and income statement values as representative values. So they want to take over this company called Takeover Target, and they are analyzing the financial statements of the Takeover Target. Okay. And they have developed the following balance sheet and income statement values as some values which are representing the values for this Takeover Target. The representative values are based on normalized historical amounts of past 3 years that have been averaged. So they took 3 years figures and they made an average of that, and they have got these values. What these this is shown in the book here. Okay. Total assets 3 years average, liabilities 3 years average, equity you will get. So you know total of assets and liability, assets minus liability is equal to equity. That's what they're showing. They're showing here. Sales, COGS, the income statement is also given. Assimilated Stores has identified 5 comparable businesses. Now they have considered 5 companies and has calculated the P ratios, price to book ratios, and price to sale ratios for all 5. That means they took average values of those companies and they found out the ratios. So need not worry, all these things are not there for you to calculate. Okay. Probably we'll see essay questions of this kind. If it is there, we'll try to see whether they are showing. So price to earning ratio on lower side, higher side, these are given. They took companies, they took 5 comparable businesses and they found out the lowest P ratio of them and highest P ratio, lowest price to book ratio, highest ratio, lowest, highest. After performing a relative risk analysis comparing Takeover Target's risk factors with the risk factors of 5 comparable business, Assimilated has determined that Takeover Target is in the higher end of risk range. That means when they compared this company with the comparables like this thing, they found out that takeovers, this is like very on a higher side. It's like on a higher side, these ratios, correct? Therefore, Assimilated has assigned risk adjusted ratios to at the low end of the range to compensate for increased risk. The risk adjusted ratios are multiplied by Takeover's target earnings, book values, and sales to calculate different indicated values. So we'll see what they're doing. So these are the risk adjusted ratios. So P ratio, risk adjusted is nothing but like based upon the risk what is involved. The ratios have been found out. Price to book ratio, price to sales ratio. These are the ratios, and they are multiplied with these 3 things. Okay, price to sales with sales, price to book with book value, and with earning, and they got these indicated values. So this is nothing but these are the values actually. These are the 11 lakh 40,000 and all those are the values which you can see here. Okay, which values are they? They are the 3 years average values, correct? Okay, hello.
Yes, sir.
Yeah, they have taken the represented values, na average values. So those average values, now they are doing the adjustment, the risk adjustment they are doing by multiplying the respective values with the risk involved in the takeover target. They got these values. When you add up all, when you see them, assimilated calculates that a fair price to pay for takeover target should be between this and this, correct? So to take, so now we will find out the stock price. So what we can do, so take out this much is the common shares outstanding. So we will divide this 114 and 132 with with this particular number of shares, and we would get the reasonable price for the takeover target, the highest and lowest price, the range. Okay, it can be between them. Please calculate and do this. We'll move forward. The only thing is you should have this representative values, which are nothing but the average values of 3 years. Okay, like assimilated stores is considering acquiring this company. In its analysis of Tego Target's financial statement, assimilated has developed the following balance sheet and income statement amounts for past 3 years, average amounts, and they have found out like they have identified 5 comparable businesses and have calculated these 3 ratios for all the 5, the lower and higher. After performing the risk relative analysis, comparing takeover's target risk factors with risk factors of 5 public companies, they have found out that takeover target is in the higher end of risk range. Okay, therefore assimilated as assigned risk adjusted ratios at the low end of the range to compensate for increased risk. Actually, takeover target is a high risky business. It's a riskier one. So they don't want to pay a higher price for that high risky business. Are you understanding?
Yes, sir.
So for that reason, what they are doing is they are taking the lower ratios and they are doing the risk adjustment to it is a very risky company. They don't want to take a higher risk. To compensate them for taking a higher risk, or see, no one wants to like go for a very risky business. So they want to do the risk adjustment on what? So like what they're doing for that, they are doing the risk adjustment. See, assimilated has determined the takeout target is in the higher end of risk range. Therefore, assimilated has assigned risk adjusted ratios at lower end. Why? Because they don't want to pay a higher price for the company. Okay, to acquire that company because of the high risk. So after doing this risk, taking these lower ratios and doing the risk adjustment, they got the values and they also found out the share price. Okay, so please go through this. I'll move forward. If finished, then tell me, I'll move forward. Hello.
Yes, sir. Just a minute.
Hello. Finished?
Hello, 1 minute, sir. One
Okay,
minute.
okay, okay.
Done, sir.
Okay, okay, okay. Now let's go for the next topic. Other equity related financial instruments. So stock rights. So I'm speaking about stock rights, or the right issue. So this is nothing but, like when company wants to issue shares, or company wants to raise additional capital, they can do so by issuing the shares to the existing shareholders. Okay, so like instead of issuing the shares to others or going for a fresh issue, they can issue the shares to their own existing shareholders at some price. Okay, probably the discounted price only. So I will read these points and we'll discuss this. It's a crucial concept. In addition to common and preferred shares, as discussed above, other equity related financial instruments include stock rights, employee stock options. This is like issuing shares to existing shareholders already who are continuing one, who are the ones who are associated or linked, or with the company. And here issuing the shares to the employees of the company. Then comes the warrants and ADRs. I'll tell you what this American depository receipts mean. Okay, now a stock right is simply the right to buy newly issued stock from the issuing company at a given price. So who has this right? The existing shareholders. They have this right, not the obligation. Let me be very frank. Right is nothing but you can exercise the rights if you feel like it is in your benefit, or it is profitable for you. Correct? So if it is not beneficiary for you, you will not exercise your rights. Okay, so stock right is simply the right to buy. So if you have a right, if you have a stock right, then you can buy the share of a company at a given price. Okay, when company is planning a new offering of stock, company may issue stock rights to its existing shareholders. Usually each stockholder receives one right for each stock owned on the record date. Okay, now rights issued to existing shareholders give the current shareholders the right to purchase new shares issued by the corporation in proportion to the number of shares they already own. So they already have the shares. Apart from this, they can also buy the new issue of shares. Okay, newly issued shares, I mean to say. So rights issued, that means these are the rights given to the already existing shareholders. And this rights, what they do is they give the existing shareholders the right to buy new shares issued by the company in whatever proportion to the number of shares they already own, because one share has one right, so 10 shares have 10 rights, so 10 shares you can buy. These rights are called preemptive rights. Why? Because these are already given. So preemptive rights may be granted to shareholders under the company's corporate charter, or they may be required by the state statute. Either the company will mention that in their bylaws, or the government, respective state government, may have these kind of provisions in their company's law. The rights give existing shareholders first chance to purchase the new stock, so they can maintain their same percentage of ownership of the company if they wish to do so. Now, rights to buy newly issued shares may also be issued to employees. That is called employee stock option. Let's understand this one. A company with this many shares outstanding decides to make a new common stock offering. So already, let me be very clear, these rights issue are issues, the rights issue, I mean to say the rights issue which is done, it gives the existing shareholders the right, it gives the existing shareholders the rights to buy the fresh issue of shares or additional issue of shares. Okay, so now company already has these many shares outstanding, and they now again want new stocks to issue and raise capital. So they are coming out with the rights issue. So a company with these many shares outstanding decides to make a new common stock offering that will increase the number of shares outstanding by 10% or this much. Okay, so company already has 10 lakh shares outstanding. They want to issue more 10% of this existing capital. So more 1 lakh shares they have to issue. If the shareholders have preemptive rights, like every share has right, okay, one right associated with it. So if the shareholders have preemptive rights, a shareholder who owns 100 shares in the company already has 100 rights, and 10 rights are required by him to buy one new share. Why? Because it's only 10%. So if you have 100 shares, so you have 100 rights, but we want only 10% of that. So 10 rights. Am I right? Hello? Yes?
Yes, sir.
So 10 rights
Yes,
are
sir.
required to buy one share at specified price, and the price is also pre-specified. Okay. Thus, a shareholder with 100 rights will have the right, but not the obligation. Let me be very clear. To buy 10 of the newly issued shares. So he requires 10 rights to buy one share. So like 100 rights to buy 10 shares. Okay. So if the shareholder decides to exercise his right and he wants to purchase 10 new shares, he can buy at a lower price, predetermined price. Okay. And if he doesn't want to exercise the rights, he can leave it like that. So if the shareholder decides not to exercise his right to purchase the new shares, his percentage of ownership in the company will be diluted when the new shares are issued. Okay, because after rights issue, number of shares will increase, and the EPS definitely has to get diluted. Okay, that means if number of shares increase, what happens? EPS gets diluted. Now, next point. So rights are issued for only a short period of time, after which they expire. If the holder of a stock right does not exercise the right and pay the required purchase price before the expiration date of the right, then what happens? Then the holder of the right does not get the new stock because he has not exercised the rights. Since you don't exercise the rights, you don't get the stock. Therefore, a stock right by itself does not constitute ownership of the share itself. It's a right you have got, so you should exercise it. If you don't exercise it, it's understood that you don't want to exercise. Hence, that right does not give you the ownership of a share. Okay. The rights offering is declared by the company's BOD, Board of Directors. Rights are declared for distribution on certain issue date to shareholders of record as of a specific date called the record date. So I'll again read this point, very important. The rights are declared. So one day they will declare that they are going to issue these rights. They're going for a rights issue. Someday the company will declare that they're going for a rights issue. and the rights are declared for distribution on a certain issue date, some date, to shareholders of record, like the ones whose name is with the company, because you know the shares can be sold to a number of people, but first time they have some records, okay, of some shareholders as of a specific date called the record date. Okay, so on some date when the rights issue is done, and rights issue is done to whom? To the shareholders of record, like as of a specific date, then that date we call as a record date. Okay, that date they are recording that these many people will get the rights. Okay, rights are declared. Okay, and the rights like are declared. So what happens? The rights are declared for distribution. So they declare that they will distribute these rights. That means they have to issue the shares not to the people who have the rights. So when they will do that, they will do it on a certain date. Okay, to which shareholders? The ones who are recorded, whose names are recorded with the company, and that date when this particular rights issue will happen to the shareholders whose names are recorded in the books is called as a record date. Now, the rights declaration also states how many rights are granted per share of outstanding stock. Usually one right per share. Okay, usually one right per share is what everyone gets. Because time is required to process stock trades. Yes, of course, it requires time to process all this trading. The declaration of the record date also determines the X rights date. That means once the declaration has happened on the record date, it's called the X rights date. That means now the rights issue, now the rights has been declared. Okay, the rights have been declared. So it is X rights date. Date by which an investor must buy the stock in order to be considered the shareholder of the record on the record date. So this X rights date is nothing but it is the date by which an investor must buy the stock. So X rights date is nothing but this is the date exactly on which the shareholders must exercise their rights. Once the rights have been exercised by the shareholders who got the rights, the date on which it is done, or from that point of time, the time period or the next day or any number of days after that, when the rights issue has been when the investors have bought the stock which were declared to them as rights issue, the time period after that will be called as X rights date. Okay, so once again I'll repeat, the rights declaration also states how many rights are granted per share of outstanding stock. Usually one right they will get. Because time is required to process stock trades, the declaration of the record date also determines the X rights date. Once the rights have been declared and on record date the shareholders whose names are recorded in the books have got the rights, then it becomes the X rights date. Now, the X rights date is 2 business days before the record date. Okay, so the record date is here and the X rights date is here. Once the rights have been declared, X rights date is 2 days before the record date. Now, anyone who buys the stock on or after the X rights date will not receive the rights. Once the rights have been declared, you have to apply for those rights. See, first what would happen? Let me be very frank and clear. First, the rights would be declared. Once the rights have been declared, you have to apply for those rights. If you don't apply, then what would happen? You won't get the rights. So you apply here, then the time period becomes the X rights date. Then the record would be happening here, and the recordings would be like the recorded shareholders whose names are recorded with the company would be given this rights shares. Okay, now anyone, yeah, that's what. Anyone who buys the stock on or after the X rights date will not receive the rights. The board of directors also sets an expiration date for rights, after which no longer they would exist and it will be worthless. So here you can see, first the rights are announced, then the rights are still on, that means you can apply for it. Okay, then comes the X rights date, that means the rights have been announced that they are going to go for rights issue. The company is going to go for rights issue, that announcement has been made. That announcement is still active or still existing till here. Then here people will apply for all the rights. Okay, the people who have the rights. So you have to apply for that because every share will have one right with it. So you have to, it is a right that you have. So you have to apply for it. And that is, this is 2 days before the record date. Then the recordings would happen, like the people who have applied, and the people who have left it like that, their rights become worthless. And then the rights are issued, okay, on the issue date after recordings are made. And then from here to here till the expiry date, this time period is called X rights period. Okay, because the rights have been issued here, it was declared. Okay, the announcement is made and declaration has been done. Here the rights have been issued. Okay, and this is the expiration date. Again, no one can apply for any rights beyond this. Now, so Zarina, we will stop here. Tomorrow, we will discuss from here. Okay. Today actually I even reached very late to home because of rains. So you follow till here, then we'll continue tomorrow. Okay.
Okay, sir.
And any doubts, you can come with your doubts tomorrow, so we can have a discussion regarding this. Tomorrow will be the just the calculation of rights issue, how to calculate the rights issue, and how to calculate the value of a right. So we'll discuss that, and
Sir,
tomorrow we'll
tomorrow
do a
can
couple
we
of
take by
questions
evening
also. Okay?
or afternoon?
Hello.
Tomorrow
Hello.
can we take the class by evening? Hello, sir.
Yeah, tomorrow
By
you
3
want by
or 4
evening?
can we
Okay,
take the
fine.
class?
5:30 something around we can take, no problem.
Okay, sir.
Okay,
Thank
sir.
you.